Joining us now is Rosenberg Research President David Rosenberg. And the recession is not obvious, David. I know you think that it's coming and you've seen it for a while, but we just don't fully see recessionary indications, do we?
Well, the data have come out pretty mixed overall, but, you know, if you focus on the spending side of the economy, you're right, Sarah, that real GDP is still positive and the run rate is 1.8%. But what I've been saying in my missives is that real gross domestic income is actually in a recession already. So you've got almost an unprecedented divide between what the income accounts are telling you and the spending accounts. But there's no doubt that if you're taking a look at the stock market and the credit market, you know, they're telling you that we're in a Goldilocks. But, you know, the odd man out is the Treasury market. And you've got to be wondering if we're into some sort of new era of inflationary growth Goldilocks. Why is the 10-year note 3.7% when the Fed's about to pin the policy rate at 5.25, 5.5? So the Treasury market's the odd man out here as far as the markets are concerned. But you're quite right. Most of the indicators are telling you the recession's not here yet. But, you know, Sarah, you and I would be having this conversation back in the summer of 2007 or in the winter of 2000, saying the very same thing.
Right.
It's probably going to take a while longer, but to say that the business cycle has been repealed, which is what we're talking about, just because the recession is not here yet in a classical sense, to say the business cycle has not been repealed and that the lag from Fed policy and interest rates as the economy resets to it isn't going to cause a recession, which is a natural part of the business cycle, to me, is a reckless proposition to make.
And I know back then they were also dismissing the yield curve as, you know, don't pay attention. It's sending different market signals, which is what you're hearing more and more of now, that it's just a sign that market expects inflation to come down and growth to remain strong. But, David, there is this thing that's different, which is the COVID give back and distortions and the pent-up demand. I mean, if you took out travel, leisure, hospitality jobs from the last few jobs report, what would the economy really be looking like? And the question is how long that kind of stuff actually lasts and how it continues to distort our economy, because isn't that what's really pushing back against the whole recession?
Right. Well, I think that's a great point. And I didn't look at it from an employment situation, but today I wrote about that if you actually looked at the economy and you stripped out consumer spending on services, which, of course, benefited not just from the reopening trade, but all the YOLO spending and, you know, the bucket list spending and all the lagged impacts of, whoever thought that all of those excess savings were going to get spent? You know, historically, when the personal sector received transfers from the federal government, half got saved, half got spent. In this, let's just be charitable and say more narcissistic society we have in our hands today, all of it got spent. And that was the Energizer Bunny that kept on giving, and it had a big impact. As you just said, on consumer spending on services, you strip that out of the data, actually, and the economy is flat as a pancake over the course of the past 4 quarters. So it's had a huge impetus. But the question we have to ask ourselves is it going to be persistent? That's the question that we have to really pose, is whether you want to extrapolate what's happening now or in the past 4 quarters to what's going to be happening in the next 4 quarters. This is the same game we were playing, remember, back in 2007, and everybody thought that, well, the lags from all the wealth effects from the housing market were going to sustain the expansion in 2008. And instead, we got a recession that nobody was expecting, just as one example. I think a lot of that impetus, and, you know, what's interesting is that in the latest Fed Beige book, you saw a lot of evidence that a lot of the fun and game spending on the services side, outside of cruise lines and outside of air travel, are starting to subside. And, of course, you're seeing that in the CPI numbers, too. You're seeing that the inflation rates in many sectors of the service sector for consumer spending is starting to either deflate or disinflate, which is telling you something, Sarah, about what's happening on the demand side. I think that's going to be a weak story for the next year.
So, David, this is Frank Holland here.
Support.